Okay, I think we're live. Hi, everyone. Thank you for attending my session. I'm going to talk about income annuities today, using income annuities in retirement. I'm joined by Derek Hageman, and he's going to be moderating this session. Derek works for AAII. He runs a dividend investing program. It's a topic that's near and dear to my heart, actually. But if you have questions or comments along the way or at the end, you can enter them on your side, and Derek will pass them along to me. Now, I know you didn't sign up to learn a bunch of things about me, but I'm just going to share a few relevant items about myself as soon as I can manage this chat box. Okay. So the first thing I'll mention is that I am a math PhD. So I do tend to focus on numbers and analysis, sort of the harder side. It also means I might not be the best or most polished or eloquent speaker at this conference. However, I do think some of my experience has given me some interesting perspectives, and I hope you guys will find the same. So the first thing I'll just mention about myself is that I was on track to become an actuary. I started taking actuarial exams actually in high school. I continued in college, and then one day the head of the actuarial program took me aside and he told me, he said, "Aaron, listen, actuaries are people who thought accounting was too exciting." So I think, or he thought at least, I had a little bit more personality than would suit the actuarial profession. So it threw me for a loop because I thought I had my career figured out. But I landed on my feet. I ended up working on Wall Street, literally 60 Wall Street back in the day. And while I was on Wall Street, technically, I worked on Wall Street, but then I later moved to London and worked from there. But I worked with a lot of different insurance companies. In fact, my particular background was well suited to helping them manage the risk for a lot of their annuity products, mostly the ones with more bells and whistles. But this gave me a behind the scenes perspective on many of the different annuity products, and I still find that useful to this day. Fast forward to a little over 10 years ago, when I started my own business back here in Florida. And now I look at annuities as tools to be used with the individual investors in retirement planning. So if I look at my trajectory from 30,000 feet, I started out on an academic or theoretical basis. Then I started to get experience pretty much at the wholesale level. And now I'm on the ground working with individual investors. I think that's fairly unique. Maybe not perfectly. Maybe there's some other folks that share similar backgrounds, but I do think it at least provides me with some interesting perspectives that I can share with you today. So again, if you do have questions or comments, I would like this to be as interactive as possible. I know the internet is maybe not as conducive to in-person questions and so forth, but I do encourage you to enter in questions or thoughts, comments, concerns. Maybe I'm too slow, too fast, too loud, whatever it is, let me know and I will try to adjust accordingly.
And Aaron, I'm just going to interject here. And so, yeah, questions do have to be actually typed into the Q&A box. So please do that. If you have a question, we'll try to get through as many as possible. And then we do typically get the question, is this presentation available? It is available. If you scroll down to the bottom of the registration page, you will find the presentation there. So with that, look forward to your presentation, Aaron.
Oh, thanks, Derek. Appreciate it. All right, onward. So here are the topics I plan to cover today. And I'm going to start out with the basics of income annuities, going into the logic behind the pricing and taxation. Then I'm going to take a step back and look at how those can offer potential benefits. And lastly, I'm going to end with a very simple example. It's a little bit extreme, but it helps make some of the points that I was presenting earlier in the presentation. So, basics of income annuities. Before I actually go into the income annuities themselves, I'm going to zoom out a little bit. I want to make sure we're speaking the same language. And also, I'm going to provide just a little bit more context about other annuity products as well. So one of the things I find is that different people call annuities, income annuities specifically, by different names. I hear the word fixed rate, annuity tossed around and being used synonymously, but basically I think it's important to make sure we're using the same language and focusing on the same thing. So I'm going to present a little bit more context. This is the way I see annuities, and it's also the way the regulators classify annuities and license people to sell them as well. So at the top, you see the primary breakdown between fixed and variable annuities. And if I start on the left and I progress to the right, you can kind of think of this as increasing in terms of complexity. So if I start out here on the left with the fixed annuity and start looking at MYGAs, MYGA just stands for multi-year guaranteed annuity. That's the insurance company's version of a CD or a certificate of deposit that you could get at your local bank. Moving one box to the right, income annuities. These are basically just exchanges of cash today for cash in the future. And I'm specifically today going to focus on income annuities where the payouts, the income, last through your life. I included a couple of examples at the bottom of the slide. The first one is what we call the SPIA, the single premium immediate annuity. And that's just you pay money today, or at least you pay money now, and it starts within 12 months. Then the DIA, or deferred income annuity, you pay money today, and then it starts at some point after 12 or 13 months. Then, while indexed annuities, moving one box to the right again, indexed annuities are technically classified as fixed annuities, but they start getting a little bit more complex, and they start entering equity type exposures. So they're sometimes called fixed index or equity linked or equity index annuities. These products are formulaically linked to the performance of various indices. They could be stock indices like the S&P 500, or they could be other indices issued by different companies. I've always thought it was a little bit cheeky for these to get classified as fixed annuities, because I always associated fixed annuities with fixed income. And all of a sudden we start to get these equity exposures. The last box on the right and on the right side of the top level breakdown are variable annuities. These are products that are technically securities. You have to be licensed to sell securities to do these products. They take your money and invest in actual sub accounts like mutual funds. That's in contrast to the fixed annuities. At a high level, fixed annuities are basically contracts between you and an insurance company where they promise to pay you, pay or perform according to some pre-specified terms or formulas. And that's where the term fixed comes from. It's sort of like a fixed deal, whereas the variable annuities focus on variable accounts, actual investments. So fixed annuities are basically a contract with a promise. Variable annuities, the money is actually invested in specific sub-accounts with market risk. It's also, one other distinction is the fixed annuities are generally your money with all the different fixed annuities and different types of products there gets sort of commingled at the carrier, and they just basically, the regulators make sure they have enough money that's going to be there in time to pay people out when they need it. So now, again, I know I'm supposed to talk about income annuities today, but I'm just going to touch on these other products. And you'll see I use the word bad here, but I don't like to use blanket statements. I don't like to say anything is 100% good or 100% bad, but that's why there's quotes around bad, and that's why there's words like potentially and not necessarily inside of the slide here. Suffice to say, I think it's important to watch out for the fees in these or any products. Some of these products are explicit. It basically just says, hey, we're going to charge you X% per year for this feature. And other products, the fees or the costs are actually embedded in the payouts of the products. That's certainly the case with income annuities, and we're going to go much deeper into that later. You should also keep an eye on the tax implications. They're not always as rosy as presented. I know a lot of people always talk about the tax deferral that annuities offer, but one thing to keep in mind with annuities is that the earnings always come out and are taxed as ordinary income, at least in taxable accounts. And IRAs and other qualified accounts obviously have a different tax treatment. That's already the case. Being taxed as ordinary income is already the case with interest from fixed income products, but it's worth keeping in mind that when you use annuities for equity exposures, so that could be your variable or index products, those gains could be getting the preferential long-term capital gains rate in a normal taxable account. But when you make gains within the annuity vehicle or wrapper, those gains are ultimately going to be taxed as ordinary income. So Another reason I don't like, I shouldn't say I don't like 100%, but I sometimes don't like these products is because they're a bit complex, and the people that purchase them, they don't always know what they buy. They don't understand the fees, the structures, the features, and I'm just going to give you one example because it's fresh. It just happened a couple months ago. I had a client of mine who came, well, it's actually a new client that came to me because she had a variable annuity issued by a very large reputable company, and they had sent her an offer to eliminate one of the income riders that were on her variable annuity product. They were basically saying they're going to increase the value of the contract by $10,000 if she forfeited the rider. So I did a due diligence. I work out the math. That's what I do. And it turned out this rider was worth more than $100,000 in future income benefits because of the way she was grandfathered in. So that's just that one decision was worth approximately 20% of her liquid net worth. So my point is just that many of these bells and whistles, they add a layer of complexity, and that can be dangerous. So enough about these. Let's get into income annuities. So income annuities are basically a transaction, money today in exchange for income for life. At least the income annuities I'm talking about, we're looking at lifelong payouts. This is, to me, the most bare bones way of making sure money lasts as long as you do. In my experience, the fewer bells and whistles with these products, the lower the costs. And I think that bears itself out over and over, at least in my experience, in the products that I look at. One key detail here, though, is that these are irreversible deals. Once you annuitize money, there's no going back. You better make sure you are 110% committed before you sign on the dotted line. Now, as can be expected, I'm a math guy, so I'm going to be discussing various quantitative facets of income annuity. That shouldn't come as a surprise when I talk about costs, pricing, and taxes. The quantitative features, I think, can make income annuities a compelling option on their own. However, I don't want to brush the qualitative benefits under the rug either. In my experience, some people are just immediately attracted to income annuities. They just look at it, they say, hey, that fits exactly what I need, let's go for it. And they don't even think about the math. I can't help myself, I want to present the math, but at the same time, I meet other people and they've just decided that annuities are not for them. That's fine too. I get it. It's, annuities have a certain stigma. Some people just can't get it out of their head. And no matter how much quantitative evidence I put in front of somebody, they're just not going to bend. And that's fine. So those are the types of constraints, people liking, people disliking, I sort of, as a financial planner, I have to account for and guide my clients through. So with the income annuities, we can think about them at a high level. Do you need one? Do you want one? Would it make you feel better if your basic necessities were covered? This is before we even start to ask questions about, am I getting value for my money? Would just knowing that you have guaranteed income, would that help you sleep at night? One of the problems that's well documented is that retirees underspend their assets. I just saw a recent study corroborating those findings, but this study also revealed that retirees with guaranteed income via pensions, annuities, what have you, they ended up spending more. They felt more comfortable that they had a safety net that allowed them to take more risk or spend more money in their other liquid investments. So they weren't as scared as running out of money because they basically had that safety net of guaranteed income. Another high level concern might be, what's the break even? So we're not going to go into deep math here, but it's reasonable to consider, how long do I have to live to get my money back? If you have to live to 100 to get your money back, that's probably not a good deal. Now, another way to think about these is, can you do it yourself with a bond ladder? Hey, I don't want to buy an annuity. Why can't I just do it myself and buy a bond ladder? How much does it cost to structure the ladder of bonds? We're going to revisit that topic down the road. But these types of questions don't require a lot of math. This is more gut feeling and behavioral instincts than math. So I wanted to mention this qualitative side before I went headfirst into the quantitative deep end. So let's go that direction now and get into the weeds a little bit more with the math. The logic behind pricing and taxation. The bottom line here is we're making a purchase, we're buying something. My question is, are we getting good value for our money? Nobody likes to overpay for anything. At least I speak for myself and a lot of clients I meet. So it requires a a good bit of math because the real costs for income annuities are embedded inside of the product. There's no little price tag that says, hey, these are our fees. You got to work out a little bit of math. Lucky for me, it's not too difficult once you have a couple actuarial tables and some interest rates to get you through it. Another question is, how would an income annuity impact my taxation? I don't know anyone that likes to pay more taxes than they have to. So that's a good question as well. So let's get into how income annuities are priced and how they are taxed. I'm just going to peek down into the chat. I don't see any questions yet, but feel free to chime in. And now that I'm going to start getting just a hair more technical, maybe that some of you guys are going to have some questions for me. Don't be shy.
We have a few that have come through. Let's if you want to take a couple, let's see. We have a question here. What is the highest percentage of your net worth that you should consider annuitizing?
So that's a really good question. I have met somebody in my local area here that I'm sure it took a lot of double checks and compliance checks, but he put 100% of his money into a variable annuity product with guaranteed income. I don't recommend that, don't get me wrong. But what's possible and what do I suggest? I guess that was more to the point. What do I suggest? It depends upon the application, but I see numbers, allocations in the 0 to 25%. Up to maybe 50% in other situations, but at that point you might be sacrificing a little bit of liquidity. Remember, the income annuities specifically are irreversible. Once that money's annuitized, no going back. So it really depends on each and every situation, but 0 to 25% I think is typical. Going up to 50 is possible, but it really is situation dependent. Did you say you had a couple more?
Yeah, yep, I do have a couple more. Let's see. This one's kind of a common theme, and the question has to do with, given the historically low interest rates, would it be considered a bad time to annuitize?
That's a really good question, and it comes up a lot. I see a lot of articles about this, and in fact, I see other topics or discussions about investing. Derek, yourself, about investing in a low yield environment. One of the things I will say is, well, very clearly, higher interest rates give better payouts for income annuities. There's no two ways about it. However, and we're going to get into this in a few slides down the road here. One of the things that people don't always realize is that the bulk of the payout in the majority of cases is principal, and the minority of each income annuity payment is actually going to be the interest component. So what that means is the amount of impact that the interest rates have on income annuity payouts is not as large as some people expect. So yes, payouts are probably as low as they've been with interest rates as low as they are, but at the same time, they're not as low as some people would expect because the bulk of the payment is principal. I'm going to step into this exact topic in a couple slides. So why don't I just defer the rest of that till there?
Okay, how about we take, let's take one more. Let's see. And just a reminder for the attendees, if you look in the live Q&A, there's an approved section and you can vote, upvote for questions. And I'll rearrange the questions ranked by votes, and we'll go from there. But here's one, Aaron. How should couples evaluate income annuities available through employers' tax deferred plans as compared to what might be available to the public on open markets?
Well, I think your question almost gave you the answer. That's what I do. Somebody comes to me with some pension options. I go in, I look into what are the various options they have there, and I compare them to the market rates. A lot of people have the option to take a lump sum or convert it to income for life. They're basically paying an insurance company to give you those options in the first place. So depending upon who they use for that option, for that risk management, to provide those income payouts within their pensions, that price sometimes comes out better. Maybe they're grandfathered in for whatever reasons. Sometimes the market comes out better. So your question basically is exactly what I would do. I would compare the options within the pension to the market-based options. And in addition, obviously, we would consider your individual situation, longevity expectations, and so forth, family histories, anything that might be relevant for that decision.
All right, great. Thanks, Aaron.
Okay, sure. All right, so income annuity pricing. Thanks for the questions. Keep them coming. Income annuity pricing. Income annuities obviously are going to depend on how long people live. The good news for annuity risk managers and the actuaries, people that price them, is that mortality is one of the two definites in life, as in death and taxes. So, and moreover, mortality is one of the more predictable variables in this equation. Let's just take an example. Let's take a carrier who's going to sell a bunch of annuity products, income annuities across the country, and they need to figure out how much they're going to charge. The general trend here is that the insurer, if they sell, say, 10,000 income annuities across the country, the general trend here is that the insurer is going to pay out almost everyone in the beginning because almost everyone is still alive. Fast forward a few years, and some of the people have passed away, according to a mortality, pretty close to the mortality tables typically. And fewer survivors translates into fewer payments. Fast forward a bit further, and very few folks are still alive. So there are very few payments. So if you think about the survivorship curve, which is that line on my chart or my graphic down there that starts on the top left, and then it gradually goes down and then goes down fast and then ends up near zero, that curve basically represents the money, the liabilities that the insurer is going to have to pay out if the mortality tables are accurate, and they typically are, especially when dealing with large populations. So once we know what the liabilities look like, how do we value them? How do we put a dollar amount on that? Well, it's really basic finance. All we need is a discount rate. So what is the appropriate discount rate? And this is a really good question. The cash flows that are guaranteed by the insurer, number one, the cash flows are guaranteed by the insurer, of course, but they're also often backed by state guarantee programs. So does that mean we should use the risk-free rate as the discount rate? I don't think that's quite right. First, we're giving up some liquidity. That's not the same as the bond portfolio or some other fixed income investment. And this deal, is irreversible. So we're giving up that liquidity. Second, even if there was ultimately no monetary risk, it was really risk-free cash flows, and the liquidity didn't bother us, there could be a potential headache of, if the insurer did go under, even if it was backed by a state guarantee program, I can trust you that's not a situation you want to go through in retirement. Luckily, it doesn't happen often. I haven't experienced one with my clients, and I actually haven't heard of one, but I'm sure there's people with much more experience in the business that have. So risk-free rate is probably not the right rate to discount these cash flows at. What about the corporate bond yield? After all, this is a promise from a corporation, the insurance company. Well, it also has the guarantee from the state, so that makes it a little bit stronger, but we also give up liquidity. So that to me seems like a fair discount rate. My guess is it's somewhere in between. But the funny thing is, it's basically irrelevant. Regardless of what discount rate we use to present value those cash flows, and regardless of how the actuaries model mortality, the tables they use and so forth, what ultimately matters to consumers is the price, not how some actuary arrived at it. Carriers don't provide actuarial tables. They don't provide interest rate curves. They just give you a price. And most people don't want to look at that stuff anyway. So let's look at a couple of examples to try to make this a little more concrete. Now, I know I said I wasn't going to discuss MYGAs, but for the purpose of comparison, this makes it very easy to see the difference between what's in the market versus what the insurance company is offering. I'm going to compare MYGAs to CDs because they're very similar in their nature. You put money in, it gets a guaranteed interest rate, you get money out. MYGAs do get a little bit of potential extra tax deferral to boot, but let's brush that detail under the rug. So I don't know if anybody in here has looked at CD rates lately. I assume some of you have, but the fact is, no matter how much you shop around right now, you're going to be hard pressed to find even a 2-year CD close to 1%, paying close to 1%. It's just the low interest rate environment we're in. At the same time, while I was working on these slides, at least a few weeks ago, I just looked up a few MIGAs, and there's a handful of really high quality and carriers that are offering, they're A-rated carriers that are offering 2-year MIGAs that are closer to 2% than 1%, 1.65 or 1.85, something like that. Now, I know this is just one anecdotal comparison, but I can tell you this is not uncommon. David Blanchett and Michael Finca, they wrote an article, that's the one you see highlighted here, about a year ago, and they made a lot more comparisons. They provided a lot more detail and analysis. But they found that MIGAs offer rates that are more competitive than CDs or treasuries, and with that little bit of tax deferral to boot. So I think this is a very simple example to just basically compare what you can get in the market to what you can get from an insurance company. Now, things get a little bit more complex with income annuities, at least in the pricing. However, if we just boil it down to the dollar amount, what do we get for our money? That keeps it a little bit easier to look at. So again, we don't have to know what the actuarial or financial models were, what models were used to price these things. We just care about the price. What do we get for our retirement dollars? So here I'm looking at a 65-year-old male. The top quote that I saw from an A-rated carrier a few weeks ago was $493 a month for a $100,000 income annuity. That works out to just about $6,000 a year, or 6% relative to $100,000. Now, one thing I'm very quick to point out, a lot of people conflate the payout rate with returns. That is not a return. That 6% is a combination of both principal and interest. That you just can't compare that with the rates of return we see in the market right now. But that's what we're basically going to do going forward here. Okay, so after I got my quote, I used the Society of Actuaries mortality table. I like to use that one because it's more reflective of the lifespans that people who buy annuities experience relative to, say, the social security tables. But I use that, the Society of Actuaries mortality table for males, and I priced this annuity, the expected cash flows based on that actuarial table. And first I discounted it with treasury rates, the risk-free curve, and then I used the investment grade corporate bond rate curve to discount it. So the calculation based off the risk-free rate indicated payments of $444. So that was significantly lower, about 10% lower than the quote I got. But the annuity is not 100% risk-free and it's not liquid. So it probably deserves to be discounted at a slightly higher rate. So I moved on and I did the calculation with the corporate bond yields. That calculation indicated a payment of about $495 a month, almost identical to the market quote. So regardless of the actuarial models, the discount rates, embedded fees, anything that went on behind the scenes, this annuity price, at least this one anecdotal price that I got a quote for, was very much in line with the investment grade corporate bond market. So that might sound surprising, but I'm going to discuss some of the potential explanations in the next section. So I put a geek's note down there at the bottom. I'm not going to get into the math here. I think I just want to stay on a certain time frame. But I just want to say that there is a lot of variability in annuity pricing. When independent agents like myself go out and get quotes, there's a lot of disparity, a lot of variability in the quotes from different insurers. They're all using different models, different rates, etc. They change their prices at different times. So sometimes somebody will update a price that reflects a higher or a lower rate. So the basic idea is, when it comes to practice, when it comes to actually getting a quote for somebody, I think it's best to quote across as many high quality carriers as possible. And I think high quality is especially important when you're talking about income for the rest of your life. I think it's always important to deal with high quality carriers, but I would up the bar a little bit when we're talking about a promise that has many years to go. So these income annuities are I'm telling you these income annuities are priced pretty fairly in line with markets and they offer lifelong income. That all sounds great. One of the questions a lot of people ask is, so what's the downside? So if 100,000, or what did I say earlier, 100,000 or 10,000 people are buying these income annuities in the previous example I mentioned, they can't all be winners, right? That would make the insurance companies losers, and we know they don't want to play a game like that. The obvious risk when you sign on the dotted line for an income annuity is that you don't live that long. So some people are going to get a raw deal with income annuities because they won't live that long. Some people are going to get a good deal because they live longer. Most are going to get something close to a fair shake right in the middle. But the basic idea is that the mortality tables bear themselves out, that curves that we saw a few slides ago are pretty much virtually identical to what the payouts experience for the carriers and had making those payments, that this is what happens. So the question is, okay, so if this is the risk, if this is a risk that concerns you or concerns anyone, if you're concerned with the economics of not living long enough, and a lot of people aren't, they don't really care what's there after they pass. But if you're concerned about these, about getting a raw deal with an income annuity, there is a solution. Income annuities offer the ability to make sure you get a minimum payout, or at least a payout for a minimum number of years, sort of the same thing. I'll use a cash refund as an example. A cash refund means that an annuity will pay out at least what was put in. If you don't live long enough to get the payout, to get the money that you put in back in your annuity payments during your lifetime, then the insurance company will step in and give the rest, the balance of what you weren't paid or what capital wasn't returned to you yet, to your beneficiaries. So the bottom line is you, or you and your heirs, won't lose any money. Another way of saying that is to say that the rate of return here is at a bare minimum 0%. You won't lose money. Not even bond funds can guarantee that because they have market risk, obviously. So that option sounds great. Hey, get my money, get lifelong income and guaranteed not to lose any money. That sounds pretty good. I actually think it is a good deal, but it costs money. So how does it cost money? It gets reflected in a lower payout. So if we go back a few slides ago, that same SPIA, single premium immediate annuity that was paying $493 a month, it would only pay $458 a month with a cash refund option, at least a few weeks ago when I got that quote. That's about a 7% reduction in the payout to get a money back guarantee. If you work out the math, it turns out the break even is about 17 years. If you live less than 17 years, it would have been good, or it would be good if you had the cash refund. If you live longer than 17 years, then you would have been better off without it. By the numbers, I do think this is a good option, or at least by those numbers. Have to take each case individually. But contrary to what I would have expected when I started working in this field, I find in my experience and my practice that most people opt for the more money option. But that's just me being a math guy and trying to optimize the dollars. Most people are, I would hardly call it selfish, but most people are more concerned with, putting their own oxygen mask on first, which they should during retirement, before they start thinking about making sure there's a good return and more money is left over for others. So this is probably a good point to check in and see if there's any more questions.
Absolutely. Yeah, they're coming in fast and furious. So let's get to a few.
And one thing I'll just say is, I don't know, I didn't ask anybody, but presumably if I don't get to some of these questions, you can pass them along to me and I can email, or somebody can just contact me on my website or what have you.
Correct. Yeah, I think that's just given the time, we likely won't get to all of them. So yeah, I think that's a good option because there are lots of questions. So all right, let's get to a couple here, and I apologize for the sirens in the background if you hear them. We're very close to a hospital here in downtown Chicago, but okay. Here's a question. Are SPIAs with inflation adjustments or some fixed percent increase worth the extra cost?
That is a great question, and one I kind of mentioned at the very end of the presentation. I was trying to get through this whole presentation without touching on the topic of inflation, but I'll give you a little bit of an advanced preview. My feeling is, SPIAs naturally don't have any inflation protection, And I wouldn't even call it inflation protection if you systematically paid more money to get those systematic increases through time. That's not inflation protection. That you're creating cash flows that are increasing, but that you're paying more money for those. And I like to source my inflation protection from outside of the fixed annuity space. There are certain fixed index annuities that directly link to inflation, but I generally like to use dividends and stocks for that purpose. Of course, stocks themselves sometimes have a negative reaction in the short term to inflation scares, but over the long term, there's a very strong correlation. It's strongest with dividends, and I'm actually going to talk a little bit more about that. Unfortunately, I don't know if it's 5 years ago, somewhere plus or minus, the one carrier that was offering true inflation-linked SPIA payouts stopped doing that. I don't know if they couldn't find enough liquidity or enough customers, but I was saddened to see that. That was Principal, and they just got out of that business.
Yeah, it's interesting you bring up that point, Aaron, because there was a question saying that the Wall Street Journal reported that Principal will no longer sell retail income annuities, and they're selling their annuity portfolio. This attendee was wondering how does that impact the decision to purchase income annuities, and if it is possible that the company will sell the contracts.
That's always a policy, and I think I have a bias to always go with larger insurers where that's a little bit less likely, or people that have been in a specific space for a number of years. However, you might get a different name on the mailbox money that comes to you, but I don't think it's a monetary risk as much as some people might make it out to be. If you're starting to go down to, Bob and Joe's annuity shack, yeah, okay, then I think there's some real risk there. But when we're talking about A-rated carriers and, Principal included, just because they're getting out of the business doesn't mean they're not going to pay back their annuities. They're just selling that business so somebody else basically makes the payments. I think one of the things we've all experienced, or a lot of us experienced, is with our mortgages, is getting that message, getting that envelope, and we got a new servicer, somebody bought your loan, these kind of things. It's really just changing the name on the paper. I won't share the recent headache I had about mortgage payments not going through when my servicer changed. But yeah, so I think that risk is overblown. Is it a concern? Depends on the type of insurance companies you're looking at, but by and large, when you deal with higher quality, larger carriers that have been in the business, less so.
Okay, great. Let's do two more if you don't mind.
Go for it.
What are the pros and cons of buying deferred income annuity, let's say to start at age 80, versus saving, investing, and waiting till later in life, let's say age 80, to buy a SPIA then?
Yeah, that's always a good question. There's a little bit of market speculation there. Hey, interest rates are low. Maybe I'll wait for interest rates to go up a little bit. But then by the time you're 80, interest rates have almost no impact. They have very minimal impact for the reasons I mentioned earlier. By the time you're 80, Principal is almost all of your income payments. Well, it's a much higher percentage of your, interest rates matter even less. I find people are more comfortable when they get their plan in place today and leave less to the market. At the same time, I do agree, if there's no other reasons, and a lot of times there are, a reason to get things in place to manage taxes or what have you. If there's no other reasons, yeah, I guess the risk is for rates to go up, not go down. But when I look at retirement, optimizing the amount of money we get out of an income annuity is not the way I want to try to achieve better returns. I think that's better done on the equity side of the portfolio, and trying to time the market, I think we all know is a challenging endeavor.
All right, let's here's an interesting one. I really want to hear your answer on this. So what are your thoughts on setting up income annuities for the year 2033, 2034, when Social Security is forecasted to drop to 75% payouts, using an income annuity to close the future gap?
Yeah, I think people that are in that situation that are near or already on Social Security, that overlaps. There's a huge overlap between that crowd and the crowd that votes. And what I'm trying to say here is I think if you're already in this situation or close to it, it makes the likelihood of DC going after your benefits. I think that's going to be one of the things where the pain is felt more by people much further out. So I think that might be overconscious. It depends. Now, did they say what age range that was, or they didn't say what age range they were? They just kind of tied it to a specific year.
Yeah.
But the younger you are, the more potential thought I would give to that. The older you are, the less.
Okay. I think let's save a few more questions. If you want to keep going, that'd be great.
All right, good stuff. So yeah, so basically we just looked at the cash refund option, and it kind of has that little bit of that cake and eat it too, which I'm going to discuss in a minute as well. So now we're going to change gears here a little bit and look at taxation. And I know this is what excites a lot of people, at least excites me. But before I go into the taxation of income annuities, I want to just kind of think about what do we compare this to? So I'm going to compare it to, let's just set up a bond ladder that acts like an income annuity out to somebody's actuarial expected lifespan. In this case, I'm just going to do 10 years. So let's say we set up a portfolio so that it yields, when we work out all the math with the interest rates and so forth, it creates 10 equal payments over the next 10 years, and then nothing is left. One way you could think about this, if you wanted to, is just buying a CD of equal notional. Well, actually, no, it would be a zero coupon bond. Excuse me, zero coupon bond where the notional was the same in each of the 10 years, and you just have to figure out how much that costs to buy that today. But the basic idea is we're going to create a portfolio of bonds that, when each year we're going to take that fixed amount of money out, consume it, use it for spending, retirement, what have you. And then at the end of the 10 years, we've structured it so there's exactly $0 left. So it requires a little bit of math, but we're not going to get into that, but it's not too difficult. So in the beginning, we have all of our principal. And I'm going to try to do, oh, that didn't work. Ooh. No, I'm sorry. There we go. So in the beginning, we have all of the principal here, and hence we're going to get a certain amount of interest based on that. Now let's just, to keep this simple, let's just say interest rates are the same. So we've structured this so that the principal goes to zero. So that means after the first year, we're going to take a chunk of that money, all of the interest and some of the principal, and we're going to go off and spend that. So in the next year, there's a little bit less principal. And if there's less principal, that means there's less interest relative to the year before. So less principal in each year means less interest, and that means less tax on the interest. So in other words, what we have is we're going to have the most interest in the beginning, most of the payment. The biggest component of interest is going to be observed in the beginning, but as we have less principal, each of our payments is going to have less tax or less interest, and hence less tax going forward. So one way to say this is to say that the interest is decreasing, and that sounds great. But another way of saying this is that the interest is front loaded, or the tax is front loaded, and that doesn't sound as great. So now let's compare this to how income annuities are taxed. The IRS doesn't want to get into the details of how much interest in every given year. They basically just look at how much did you put in and how much do you expect to get out. And they only tax the amount of money that's above and beyond what you put in. And they take a ratio. They take your initial investment and they divide it by the total value of expected cash flows. And that ratio tells you how much of each payment is going to be principal. At least the IRS is going to deem it to be principal, so that the remainder is interest. So the point I'm trying to make here, and maybe not too clearly, is that the IRS just uses one ratio and applies it to all of the income annuity cash flows, at least up until a point I'm going to discuss in a second. And what that means is you're going to pay roughly the same amount of tax, but instead of being front loaded like it was in the case with the bond portfolio, it's level through time. That's just the mechanics of the way the IRS taxes income annuities. Now, once you get all of your money back, and that is worked out, the math is worked out such that that happens at your actuarially expected lifespan, the rest of the payments are going to be 100% taxable. I jokingly call that free money because that's sort of icing on the cake. The annuity is priced so that those first cash flows, these cash flows to the left of the red line, are priced in line with the corporate bond market or the market in general. And then these other cash flows are your, well, you can call them mortality credits. I don't like that word. I'm going to discuss that in a minute. But the basic idea is you're one of the lucky ones that live longer and you end up getting a bit more money back. But because the IRS hadn't accounted for you getting that, they didn't account for you to get that much money back, that income becomes 100% taxable. So the bottom line here is that the taxation on income annuities is level, whereas with a bond portfolio, it would be front loaded. And one thing came up, this came up with a client. It was a very good question. I just wouldn't have thought about it before, but a handful of years ago. And the question was, what happens, if you pass before receiving all your principal back and you don't have a cash refund? Well, the IRS actually recognizes this. They call it something like unrecovered basis. That is, if you don't get all your money back, that is, you took a loss on your annuity, it can actually be taken as an itemized deduction in the annuitant's final tax return. Anyway, that was an interesting tax quirk I had not experienced or didn't have experience with, but somebody had interestingly asked. Very good observation, very good question. Okay. So now that we've kind of gone through some of the pricing calculations and the tax rules, I'm going to revisit those and see how they might be able to generate some benefits for us. So the first thing that I find is obvious, especially for those of you that use advisors, if you put money into an income annuity, that money is typically not included in your advisor's asset management fees or their AUM fees, assets under management. So, I mean, there might be some advisors out there that still include income annuities. I don't do that, but the basic idea is there might be some costs embedded in the income annuities. We discussed that in the previous section, but they don't have any further, they shouldn't have, in my opinion, any further advisory fee lapped on top of them, as they would if you had a portfolio of bonds managed by an advisor. The other thing I mentioned earlier, just touched on, was mortality credits. As I said, I don't particularly like that term or that label, but the basic idea is that income annuities are really capital efficient in terms of establishing income that'll last as long as you do. So let's just say you have a mandate or a desire to establish a stream of income for the rest of your life. If you replicate that with a bond ladder, you're going to have to go 1 or 2 standard deviations or a number of years beyond your expected lifespan. And that's going to require some additional money, or it's going to require you to lower the payments. But if you use an income annuity, which are priced to your life expectancy, instead of those extra years, 1 or 2 standard deviations of on your lifespan, that can free up some capital that would otherwise be tied up in the extra rungs on that bond ladder. You'd have to extend your bond ladder to make sure you didn't run out of money. You really don't want to run out of money when you're in the middle of your later stages of retirement. So annuities are priced closer to your average lifespan, but the bond ladder would have to be extended well beyond and would cost more. The last benefit I'm going to mention here just relates to the cash refund option. I kind of foreshadowed to this, but I think they're particularly attractive in the current environment. Let's just assume the worst case scenario. You only get your money back. That's the worst case scenario, the 0% return on your money when you choose the cash refund. You don't live long enough to get the extra money. You just get your money back. So what's the cost in that situation versus buying bonds? You might not get, you only get your money back. You didn't get any of the interest on the money that you would have received with bonds. Well, in this market, that's fairly minimal. Moreover, you still have all the upside if you do live longer than expected. So I think this is one of the areas where actuaries are actually missing out on the concept of a risk premium. Bond portfolios have some risk, maybe not as much as equity portfolios, but there's still market risk there. And I think the annuity in guaranteeing you get your money back, I believe that has more value than they're currently pricing into their products. Okay, now here's a little bit more thinking from the perspective of the carrier. Income annuities are a straightforward actuarial exercise. So they don't need to embed extra margin to cover unforeseen risks. Less risk means less risk premium. That means better prices for us. When there's unexpected risks, they have to bake in a little bit more of a buffer or a cushion so that their profitability doesn't get damaged. But when you think about income annuities and you think about how that balances the risks from their bread and butter life insurance businesses, the risk with life insurance is that people die sooner. The risk with income annuities is that people live longer. So from a risk management perspective, these products tie together really well. They sort of offset the longevity risks or help hedge each other. So between the ease of pricing and the risk management angle, I think these are some of the drivers of why the pricing is competitive and very close to being in line like we observed earlier with the investment grade corporate bond market. However, I do think there is another role or factor that plays probably the biggest role, and that's the consumer. So because income annuities are so simple, it's very easy for us as consumers to shop them around. Now, I can't say this when we talk about index annuities or variable annuities, too many bells and whistles. And even me with a math PhD, I don't have the models or the tools on my desktop or at my disposal to properly value those complex products. They have some really, they might sound simple, the guarantees that they embed in various annuity products, but when it comes to pricing and valuing those things, I can tell you those products end up on the exotic derivatives hedging desk at investment banks and reinsurers that are equipped to do so. Income annuities have none of that. Very simple. Money today for money for life. And it's very easy to compare that from one to the other. So when it comes to income annuities, I just go out, I get a list of income annuity quotes from high quality carriers. I order it from best to worst prices. And more often than not, the top quote is what I recommend to clients. In some cases, if it's close and the client recognizes or is more familiar or more comfortable with one carrier than another, maybe we'll go with a slightly lower payout to go with New York Life or some other insurer that they're very comfortable with or has a longer history. But the basic idea is that income annuities are very easy to shop around and compare, and that helps keep the carriers honest or on their toes in terms of pricing. If you really want to get into the weeds, even if you had two carriers giving you the exact same quotes, often the exclusion ratios are going to be different because they have different actuarial models and different discount rates. And even with the same payout, the difference in exclusion ratios can be used to your advantage. That's one more tool in your quiver to help optimize taxes. Because a higher or lower exclusion ratio can work out to your benefit if you want to pay more or less tax now versus later. Anyhow, that's kind of getting deep into the weeds. At a high level, most people just go for the highest payout. So might be another good time to take a couple questions before I jump into the tax benefits.
Yeah, definitely. Let's take a few more and just a time check. It looks like we have about five more minutes left in the planned session. So I think we can go over a couple minutes, but let's go to a few questions here.
Okay, maybe we'll just keep it to one question then, because I think that creme de la creme, some of the important stuff is still to come.
All right, great. Let's do one. Should I put this into my IRA or taxable account?
Okay, great question. Comes up all the time. Typically, I like to use IRAs. It depends on everybody's individual circumstances, as always. So there's always that caveat. But one of the things I like about putting these into IRAs, one of the tricky things in retirement specifically is, if you're using income annuities, you're thinking about retirement. One of the trickiest things in financial planning or retirement planning is your withdrawal strategies from tax-free buckets, from taxable buckets, from tax-deferred accounts. And we're really trying to minimize how much we poke our heads up into higher brackets. I'm going to touch on this in a page or two. But the IRS made a deal with carriers, or gave income annuities a blessing, that if you transform your IRA or part of your IRA into an income annuity, those income annuity payments are deemed to be your required minimum distributions. So the benefit there, from a planner's perspective, is that gives me and you as a client predictability of income down the road. And that's really important. On the contrary, if you had that money in a bond portfolio, a bond fund, or whatever, you simulated your own bond ladder, you're still subject to, it wouldn't be as much volatility, but there's still some volatility around the value of the portfolio, and hence what your RMDs are going to be year from year. Okay, so if it's okay, I didn't realize we're getting a little bit close. So let me just touch on a few potential tax benefits, and I just mentioned one, so I knocked that out of the way. Going back, I think a lot of people hear about annuities are great for deferring income. I explained how they can help you level your taxes versus front loading your taxes. I wrote this research article here, how you can squeeze a little bit more tax juice out of income annuities by using a combination of a deferred income annuity and a bond ladder. But the point is, and as this question just kind of hit on, there's broader planning opportunities here with annuities. It's not just annuities in a vacuum. I like to look at a more comprehensive or holistic picture of people's retirement, and in particular, the tax planning. So I think, the IRS tax code is already annoyingly complex, but I can tell you it's ridiculously so when it comes to retirement income planning. You can think about the overall idea, like I mentioned, is kind of not trying to level your income. Try not to poke up into the higher tax brackets. We have a lot of tools in our quiver here, required minimum distributions, annuities, Roth conversions. We can use these things. We can try to structure these things in a way to be as tax efficient as possible. But I will tell you, Social Security takes the cake for injecting the most complexity into the process. The taxation of Social Security, on the face of it, is just a few simple rules, but it has severe domino effects about knocking other income into triggering more taxable income. If you're not aware of the, Social Security tax torpedo, you owe it to yourself to look it up or seek out some advice on that. It can really double your marginal tax rates in some instances. So there's other arrows to dodge here: IRMA, Medicare surcharges, net investment income tax, and so forth. But the point is, managing your taxable income in retirement can be critical, and income annuities can help you do that by giving you a little bit more control over the timing of income. And just like I mentioned with that question, it can give you more predictability about the income with the RMDs when you use retirement funds. I'm going to skip over this benefit in the light of time to move into skip over a couple slides here, because I want this example, I think, is very illustrative of some of the benefits I've discussed. A very common situation I find is retirement is that somebody wants to have income for their retirement. It needs to grow with inflation in some way. They want that to be a growing stream of income, just in case to combat inflation. But they also have kids, or maybe they have charities or other legacy goals as well. And so they want to have a little bit of money left over for those folks. The idea that I'm throwing out here is to, and I'm not suggesting this, but just for illustrative purposes, let's say somebody's in a 50-50 portfolio. Instead of thinking about the 50% that's in the fixed income side, let's annuitize that whole thing. let's create a pretty chunky baseline of income because we're getting both principal and interest back through time. So we saw before that 65-year-old male gets about 6%. So on that payout, total payout. So if you do that with half your portfolio, that's 3 full percent of retirement income. And then on the stock or equity side, let's focus on high quality dividend raisers. That is, companies that have paid and raised dividends for some period of time. And if we think about those dividend companies, we don't think about the capital appreciation there as much as just taking the dividends and stacking that on top of that annuity baseline of annuity income we just established. So now, as long as that income suffices, that we can get maybe on the order of 4%. It depends on how old somebody is, and how you structure it could be a couple, joint payout, and so forth. Brushing a few details under the rug, but if that income is enough, then the nice thing is you still have the equity portfolio in the background. It's liquid in case you need it. Maybe you have that for healthcare expenses or something else that might come up if that's not already covered. But the portfolio corpus, the stock portfolio, it's not really a concern anymore. Markets go up, markets go down. You're still getting the dividends, and those come straight from the companies. So you've basically taken the market risk and you've left it in the portfolio that's going to end up in the laps of your heirs. And that's an ideal place to put it because they have the longest time horizons. So, okay, so what are the benefits here? So number one, if you can get by on that income, there's no need to rebalance. You've eliminated any advisory costs. And when you work out the math here, even including the cost of an annuity, we're talking about handfuls of basis points per year if you amortize the cost of an annuity through your retirement. So typical advisors charge 1%, use funds that maybe charge more. We've gotten retirement down to about 0.1% per year. But importantly, without any rebalancing, and I skipped over one of those things, but your fixed income side of your portfolio is shrinking. Your fixed income side of your portfolio is the least tax efficient because of all that ordinary income from interest. It's kind of shrinking through time because the annuity effectively consumes it, or you're consuming the income from the annuity. You're not topping it up and rebalancing a portfolio. That creates additional tax benefit. So just this, without any of this retirement withdrawal optimization, this reduces in a taxable portfolio investment related taxes. That's the stuff due to rebalancing capital gains, the interest from bonds, and the dividends, taxes on dividends, reduces investment related taxes by about 25%. I've written some research articles on this. I'd encourage you to look at those if that's something that intrigues you. I've research on dividends and how those relate to inflation. Derek would probably be a great source of information on that as well. I've included the link to my research articles, but if this is a strategy you find intriguing, I'd encourage you to reach out to me because I need some help with some beta testing on a new platform or tool that I'm developing. So if that is something that interests you, please do reach out. So in the interest of time, and apologies for getting a little bit fast here in the end, I'll just leave you with some parting thoughts. Obviously, I don't think all annuities are bad, despite what some folks say. It really comes down to how they're marketed, how they're sold, and how they're executed, how they're used in your entire financial plan. I think the simplicity of annuities, the alignment with your retirement needs, it makes a strong value proposition. Now, obviously, I focused a lot on the quantitative benefits, but I'm going to go back and say, I think the qualitative benefits actually provide the most peace of mind. I'm throwing numbers, I can throw all the numbers I want at people, but just if it hits you, it sits well. If you have a good gut feeling about it, it's probably good for you. But if you're starting to question annuities, I don't know, and you're not getting over some reservations, then probably not. So I'm just going to end this with one phrase that relates to the qualitative aspect, and just a phrase that stuck with me. And somebody said, really in the context of marketing income annuities, but the idea is to protect the income you need so you can try and maximize, you can take more risk in other places to maximize the income for things you want. So that's it for my slides. If we have a little bit more time for Q&A, I'm ready.
I think we are at the end of our session limit, but if people do have questions, is there a way they can reach out to you, Aaron?
Yeah, you can just go to my website. I'm very easy to find on the internet. There's a contact page. You can enter questions into a contact form. You can set up a free consultation. It doesn't have to be a consultation, or you can just email me. You can even write a letter and put it in the mailbox if you like.
All right, lots of different ways to get in touch with you. And I'll just say, I'm sure glad your Professor Bruce Edwards kind of steered you in the direction he did, because I think we all learned a lot today and benefited from your presentation. So thank you very much, Aaron.
Yep. Thanks for everybody for attending, and Derek, you for moderating.
Definitely. Have a great day.
All right. Thanks.